Hey everybody, welcome back to Dividend Stockpile. Today we have a very special guest. Adam Patti, CEO of VistaShares, is back with us to talk about a brand new income ETF they're bringing out today. This is the same team that's brought us the extremely fast-growing OMAH, QUSA, AIS, and Wild ETFs. And they're here to talk about their brand new Target 15 ETF, the VistaShares Target 15 ACKtivist Distribution ETF, ticker ACKY. This one is so brand new that it's just being launched today, September 9th. So I love bringing you the latest and greatest in the income ETF space, and today I'm sure will not disappoint. So, Adam, welcome back to the channel for the third time. How are you doing?
Oh, Jeremy, great. Really well, and thanks for having me on. I really appreciate your time and having the opportunity.
Absolutely. So when you reached out a couple weeks ago to tell me about this new ETF, I was like, we have to get you on board. I want to do it as soon as possible. I think this one's going to be a very, very popular ETF. So I wanted to get you on as soon as possible. Again, the ticker's ACKY. High level, can you tell me what this one's all about?
Yeah, I mean, we're really excited about this one. We launched OMAH 6 months ago, and it's almost reached 500 million in assets, which we're very fortunate and humbled to see. And, it became very obvious that investors are looking for diversification in their large cap exposure. If you look at the S&P and the Qs, you've got 35 to 45% of the same exposure in the top 10 holdings. Most investors don't know that they have a lot of over concentration risk. So they're starting to get that, and they're starting to look for diversification. So OMAH took off. I mean, who doesn't want to invest like Warren Buffett, but with 15% annual income target paid monthly? So we saw that resonate, and we said, well, let's do some more research and let's find managers who are legends, who tend to have high conviction picks that they hold for a long period of time. We weren't looking for rapid fire traders or people who are doing a lot of hedging on the short side. So we came up with a short list of investors, and of course, Bill Ackman is a legend. We're huge fans of his and everything he's accomplished. So, as a tribute to him, we felt that ACKY would be a great addition to our suite of products. And so it's very similar to OMAH. It's a very different portfolio, but it's the core portfolio of publicly traded holdings that he has in his at Pershing Square. And we have the same options overlay, data-driven options overlay that generates 15% target income annually, and we pay it monthly, where we're seeking 1.25% per month.
Yeah, so again, to your point, Bill Ackman is very well known in the community. He's been a legend, if you will, in the investment space for almost a generation now at this point. Very high conviction, very targeted exposure. He really gets behind the investments that he makes. So following that mindset and that skill that he has is a perfect fit for this type of product. Plus, you get that monthly income, which is what we all love here on the income side of things. I love that you guys called it the ACKtivist Distribution ETF, because Bill Ackman is known to be an activist investor. So can you talk about where that name came from and why you chose ACKtivist Distribution ETF?
Yeah, I mean, it's a play on words, obviously. We thought it was clever and illustrative of what we're trying to achieve. I mean, we are clearly, and I like to say this, we are clearly not affiliated with Bill Ackman. We're not affiliated with Pershing Square. We're just, this is a tribute to him. And we feel like, we built a product that went through a lot of rigorous testing over time. We looked at the portfolios going back years and tried to determine, is this the right pattern of performance that investors are looking for? And we felt it was. And if you look into the portfolio, it's very different than most people, own. I mean, there's some names, there's the Google, there's the Amazon, which you just added, but there's a lot of names in there that most investors probably don't have a lot of exposure to. So, him being the best activist investor, and of course, his name ties into it really nicely. So we thought it was a clever name.
Yeah, no, a good choice there. All right, so for everyone, high level, it's going to seek monthly income, 15% paid monthly. It's going to have a core equity exposure, the top 10 to 20 names, and the Pershing Square holdings. And then you're going to do your professional options management, which in this case is going to be cover calls on the positions that Bill Ackman and his fund hold.
Spot on. And one thing I always like to mention, because, we're in this community, there's many different types of income products, right? There's the nosebleeds, there's the lower income ones. We are not waking up in the morning looking to maximize income. That is just not what we do. These products are designed to provide consistent, steady income. We want people to understand what they should expect. Now, we can never guarantee that we hit our targets every month. There's no guarantees. Of course, we have with OMAH and as well as QUSA. So we are looking to generate 1.25% per month, not 1.26, not 1.24. If we somehow generate more income on a monthly basis, we're rolling that back into the NAV. We're not paying that out. Target 15 is in our name, and that is what that is the goal of the product. We want to hit that number as well as provide capital appreciation.
Yeah, and I think that's the biggest thing is you want that total return. There's so many high income ETFs that are paying 70, 80, 100% distributions, but then the NAV goes down because, there's no upside potential. So by only writing on a small portion or a portion of the holdings, you're still allowing the fund to increase, and keeping it at 15% is a very conservative, reasonable option strategy. I know when I sell my options, I'm looking for about 0.5% a week. So that's going to be 2%. You guys are only going from 1.25, and I feel like I'm very conservative. So 1.25 might even be even more conservative. So you're going to get that income, you're going to get on a monthly basis, but then you're going to leave the rest of the portfolio available for the upside potential, which I think is perfect.
Yeah, I agree. I mean, we chose 15 after doing a lot of research also before we filed for OMAH. It's above a lot of the competitors who are also bringing out more asset allocation focused products, which is what this is. And it's well below the nosebleeds, which are a very different use case of those products. And, people love them and they should. This is an asset allocation product. It's for portfolio diversification. It's a core holding.
Yeah, absolutely. Speaking of core holdings, let's talk through the holdings as of today. Obviously, this is subject to change based on Pershing Square's quarterly updates that they provide. But we're looking at Uber, which everyone knows Uber, Brookfield Corporation, which honestly is one of my favorite companies in the world. We'll talk more about that in a second. QSR, which is Restaurant Brands International, which is like your Burger Kings and things like that. Howard Hughes Holdings, which is a real estate play. Amazon, Alphabet, Chipotle, and all the ones we've all heard about. But Bill Ackman and his team has done the research and the conviction for these particular names, and that's what they're looking at. Some of the smaller holdings is Hilton, Hertz, and Seaport Entertainment Group. So that rounds out their portfolio as of today, again, subject to change. Can you kind of give us an idea of what your feeling are about each of those holdings?
Yeah, look, it's an interesting portfolio to me because you do have the high growth names. The Amazon, which you just added in this past quarter. You have the Alphabet, but you have some defensive names as well, and names that frankly should do very well if interest rates drop, which I hope they will. And the restaurant brands. You've got the quick service restaurants. You've got the real estate plays with Howard Hughes. So you've got a nice diversified portfolio. So it's not a growth portfolio. It's a kind of a mix of a growth and defensive, which is I think tailor made for today's environment, given all the volatility we've seen. And then with layering on the 15% income, regardless of the market conditions, at least you're getting your income on a monthly basis, which we think is important.
Yeah, I mean, these are long-term. These are companies you can hold for forever. But to your point, with the interest rates bound to come down over the next couple of months or years, a lot of these names are really going to benefit from it. So the real estate, of course, we have Seaport Entertainment, which is like baseball stadiums and Seaport entertainment districts and things like that. You have Howard Hughes, which does like master plan communities, which obviously take on a lot of debt to get going. And so those are going to benefit when there's lower interest rates. But we also have things like Brookfield, which is a huge player in the private equity space. And a lot of their stuff is funded by interest rates, and the economy runs on these interest rates. So a lot of these names will benefit over the next couple of months. Then you have a lot of the consumer names, which if the consumer's feeling better with lower interest rates, they're probably more likely to go and spend and go buy that Chipotle burrito or go to Burger King and things like that. So I think it's in a really good position for what's about to come.
Yeah, and look at Uber. I mean, Uber is an incredible company. I mean, my gosh, everyone thinks of it as a ride-hailing service, right? But the Uber Eats is taking over that whole space, the whole autonomous vehicle division that they're building out. I mean, it's an incredible company that clearly he believes so, but given the large stake he has in it, and we're thrilled to have it in the portfolio.
Yeah, and they also have the Uber Freight, which is a whole other aspect that no one even really talks about. That's another avenue for revenue. Yeah, so Uber in the portfolio right now is a little over 20% of this ACKY. We have Brookfield at about 18%, and QSR, which is Restaurant Brands International, at 10%. So, some concentration, but really not too much when you look at the overall portfolio that you have right here. Now, obviously, those are subject to change. So how do you guys determine which holdings are in the portfolio at any one time?
Yeah, so the way we've designed the portfolio, again, similar to OMAH, right? So we think it's important to have a index core. So we're an active ETF. but we're active to the index. So what that means is the core of the portfolio is run in a rules-based fashion. This way, investors can go onto the rule book. They could see exactly why any particular holding is in that portfolio. So we think that's important. We like transparency. So, however, in a product like this or OMAH, if there's moves that are made by the manager in between the 13F filings, which is what we're monitoring to get to the holdings, and if it's publicly disclosed, we can make those changes in between within the quarter. So we think that's important. And look, so people say, well, you're looking at 13Fs, there's a delay. So yeah, if there's a change in the 13Fs and we don't pick that up earlier, it's an average of a 45-day lag. Right. So, assuming it wasn't made the first day of the quarter and we're waiting for the entire time. But, 45-day lag is really not that big a deal, especially in a portfolio where there's high conviction long-term plays. If he was moving in and out of positions, it just doesn't work. And which is why we didn't choose managers that do that. We want long-term holds. But again, we can make changes intra-month if the SEC filing goes across that he just took a 5% stake in something, boom, we can make that change before the 13Fs come out. And we think that's important just to stay nimble. And that's what our investment committee is for. We're overseeing all of our portfolios on a daily basis to identify risks and opportunities in our portfolios.
Yeah, no, it's great because to your point, there are some times where these large asset managers have to disclose, new stakes outside of the 13S. So you're able to pick up on that and adjust accordingly. Now, the index.
Be clear, we're not overriding his picks. I want to make that clear as well. I'm not that smart, so we're not going to be overriding his picks. If anyone would ask, well, you're active, you can make changes. We're not changing his picks.
Yeah. And so with that index, you're going to look at the top 20 that he could possibly hold in the Pershing Square at any one time. Sometimes he has more than that. Sometimes he has less than that. But you're going to do the top 20 in the portfolio, adjust based on the weightings. But you're expected to have between 10 and 20 holdings at any one time in this portfolio.
Yeah. And I think that's kind of the average if you look back over time. And the holdings will be generally in the right percentages of what he holds in his portfolio. Now, of course, he might have privates in there, which we're not capturing. We're certainly not taking his cash positions in there. And, we have diversification rules on a 40 Act fund that we have to stay true to. So there might be some tweaks to the percentages of holdings, but generally it'll be a nice carbon copy of what he's got on the publicly traded side.
Yeah. And, all those names are very well known and done well over time. So I have no doubt that they'll continue to do well over time. Let's talk a little bit about the option strategy a little bit more. I know you do 1.25 a month. And, looking at the individual holdings, there are some that you're going to be able to get way more than that on a monthly basis, but you can be more conservative. So are you going to go farther out of the money? You're going to go longer time frames? How are you guys building the option side of the portfolio to get that 1.25?
Yeah, so we're writing covered calls on each one of the holdings. We cover the whole portfolio, and the duration of those options will depend on the volatility of the underlying, right? So, to your point, if we can make that 125 fast, we're gonna minute we hit that 125, we're out of the position. So we're not holding positions trying to squeeze out that last percent. We don't want that. We don't want anything called away if we can help it. So once we hit that 125. We're out of the position and we're re-rolling into a new position, if necessary. We want to retain that upside capture on the capital appreciation side as best we can. So, it's a data-driven strategy. Every morning we go in and we're looking at the different holdings. We're looking at the options market. We're seeing where we stand on each position, and it's straightforward. It's actively managed. It's not rules-based, but we use a set of rules to run that strategy. So, if for some reason we make more than 125, we're rolling that back in the NAV. We're not distributing that. Any dividends from these holdings is not included in the 15% or the 125 per month. We're rolling that back into the NAV. So, we want to keep that NAV growing, which is particularly in a growthy portfolio like this. So that's what we're looking for.
Yeah, I know some people's biggest concerns when it comes to these higher yield ETFs is that, you're not getting any capital appreciation or NAV growth in the portfolio, but it seems like you guys have a plan in place to build the NAV as well as to provide that income.
I was just going to mention that obviously your listeners are savvy, so they already know this, but any strategy that uses an option strategy is going to cap the upside. right? So, you're not going to get 100% of the, of the equity portfolio. I tell everyone, look for 70 to 75% on the upside, 85% of the downside, or so, as kind of a range. And I want to make that clear. You got to look at the total return of the portfolio to really identify whether it's doing what it's supposed to be doing or not.
Absolutely. So you can be really conservative and allow a lot of the upside capture on those options because you're only looking for that, 1.25, maybe even less than that, depending on what other investments you guys have and what kind of dividends you get. So overall, great package. I think it's going to be really popular. Obviously, Bill Ackman and Pershing Square Capital is a very popular fund and manager. You get the 15% income on top of it. I mean, you really can't beat it. Where can people find more information?
Sure. Our website, VistaShares.com. The fund page is up. Our fact sheet's there. We have an investment case up there as well. When you get there, you can see our other strategies. Now, this is a new strategy. So our first distribution is coming out at the end of the month. But you'll see from QUSA, which was launched in May, or OMAH, which was launched in March, we've hit our 125 every single month, and we don't expect that to change. But again, no guarantees. But we don't, we think that's doable, and which is why we set that level. And so hopefully people will find this attractive and then give us a shot.
And when given your history with Omaha and some of your other ones, I mean, it's definitely something to really take a look at. You guys are come out of the gate strong. You're providing exactly what you said you were going to do, and your NAV is keeping up. So I think it's an overall great package so far. Obviously, no guarantee for anything in the future. We know how that goes. But again, you have a good strategy and a good product. And that's why I wanted to bring it out to the audience. So thank you so much for joining us today, Adam.
Oh, I appreciate it. Thank you very much for having me. It's a lot of fun.
Absolutely. We'll talk to you soon then. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.